Welcome to the Market Huddle with Patrick the Content Machine Serezna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's February 15th, 2019, episode number 15. I'm Patrick Serezna.
And I'm Kevin Muir. Thanks for taking time out to join us. The Market Huddle is a weekly show where Patrick and myself get together over a couple beers to talk about the week's action in the market, making sure to keep each other's feet to the fire and have a little fun in the process.
Now, this show is broadcast to us as both a podcast and on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on those charts and videos we're referencing, you can register at markethuddle.com website and get the weekly email, which includes the chart pack and video links, or just flip over to YouTube.
In this week's episode, we get caught up on what Patrick is thinking about the markets, and we take a deep dive into quantitative tightening with Barton from Barton Options.
Yeah, and Barton will also share with us a tale from the trading desk, and afterwards we're going to get to this week in trading history, where we're going to go back 20 years, where it was the first time when Japan lowered its interest rates to zero.
And for our WTF clip of the week, Bill Gross retires Austin Powers style. And then we end with the five most important things to watch next week. Let's jump right into it. Patrick, who's the show brought to us by this week?
Well, this week our sponsor is the Double Trouble Brewing Company, and the beer that we're sampling is called Hops and Robbers.
Hops and Robbers. I like it.
I like it too. It's extra delicious IPA. So let's find out what we got here. Ooh, that's quite hoppy. That's no. You know what though? It's good. I mean, listen, when it's called an extra delicious IPA, you have to expect a nice hoppy taste, right?
Oh, but I've trained you well, Patrick. No more getting insulting our sponsors. I'm really proud of you. You made it.
Well, listen, it was it's great to be back. I listened to the episode that you and Tony put together last week. It was great to hear Tony's voice, but I felt so left out. I was like, I want to be in there.
Yeah, well, we missed you, and although I heard that someone told me that Tony chugged his first beer and very quickly went on to his second, so he kept his kind of his reputation intact.
Oh, that was well. I would do it too, but you know what? I'm gonna take it easy right off the bat, and you know what? With the taste of this beer, I think I'm gonna be on to a second one by the middle of the show. We'll see.
There we go.
Anyway, listen, Kev, your legal shit.
Yeah, that's right.
Go for your disclaimer.
Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include Smurf hands, parking meter head, and or cottage cheese ankles.
Well, I'm not sure what cottage cheese ankles are, but you know what? I hope I don't get any.
That's right. Okay, so Patrick, everybody's missed you for the past week. We were dying to know what you're thinking about the market, and you got to just walk us through some of your thoughts about what's happened in the past couple of weeks and catch us up.
You know what? What a crazy couple of weeks, hasn't it been? The one interesting thing that continues to baffle me. I'm going to just pull up the dollar index chart over here. But you know what? The moment that Wall Street Journal article came out that we were talking about, it came and reversed the dollar index lower. And then Powell, we were making fun of it, taking the knee. I really thought that would open the window for dollar weakness. Really, it held, and more importantly, the dollar broke to a higher level now than it was before this whole thing began.
Well, and I think I commented about that I said I think the next week I said, if you get a market that gets all sorts of bearish news but doesn't go down, then it's most likely stronger than everyone anticipates.
Yeah.
And to me, it felt like the final of the dollar bulls gave up on Powell's announcement and that was how it barely went down, and then we've been chugging higher. I actually think, Raul Paul from Real Vision, he said that he thinks the biggest surprise of 2019 is going to be a dollar breakout to the upside. At this point, so few people are expecting it now that if it does happen, he's going to be right that it's going to be the biggest surprise of 2019.
You know what? Maybe it's a bias because I've been bullish the dollar the whole time. That maybe I'm just not listening to how many bears there are out there. But I mean, I'm still in that camp, and I have been. But one of the charts to me, though, Kev, is about that euro. I mean, it's at the edge of the cliff. I keep telling my members, I'm like, listen, this thing is like at the edge of a cliff, and it's got a very weak grip. All it needs is one push. I mean, if someone gives this push, it's going down the cliff. This is a weekly chart, and I just have it marked off there, that low from 2017. And I just feel like we're at such an important level right in here. Like you look at where all these highs and lows, if we put on some volume by price levels, we'd see a big cluster right in here. Like if we give out this level at around this kind of 113 level, that's kind of a invitation for the euro to go and retest some 2017 lows. And I just think that's a big level to go to.
The European economy continues to just shit the bed. It's awful.
Shit the bed. It's
crazy. I think Germany just barely escaped recession in terms of the fourth quarter. Italy, I think, is in one. It's just the bad news continues, and there's not much happening. And I see today that Benoit Cœuré, which I believe is one of the Draghi's right-hand man at the ECB, he came out and he's talking another LTRO, which is long-term repurchase operation.
Yeah.
And they're just talking about throwing in way more monetary stimulus into it again.
But isn't it interesting? Like they really don't have very many conventional monetary policy tools left because they're going into an economic downturn and they didn't raise interest rates, so they don't have room to lower them. They have to go straight to unconventional measures of monetary policy to stimulate at this point.
It's batshit crazy what's going on there. Like they just can't get themselves around the idea that the realization that they need to do fiscal, and that more monetary stimulus is not going to help anything.
Yeah.
It's just anyways.
They should just let Italy run. They should let Italy run a big budget deficit, right?
Well, the reality is that Germany should be spending. Germany is actually like, what do you think the deficit is in Germany? And the reality is it's not a deficit. They're running a surplus. They're running
really?
They're running a 1.7% surplus. So they need to. We need Germany to just spend, and until that happens, it's a very, as you mentioned, like the charts are showing how precarious it is, and it's scary looking. So let's go on. What else do you think? Well, like what else were you watching?
Well, the one thing I wanted to talk about was these bonds, right? Like one of the things now, me and you have this debate all the time. I'm much more bullish bonds. You're not so bullish bonds.
No, I have been bullish bonds over the short and medium run.
Okay.
Long term, I think they're certificates of confiscation, but I do believe that especially U.S. bonds. There's a good chance that the next move is higher, not lower.
So technically, there's a triangle formation developing on the 10-year and the 30-year. They're kind of consolidating sideways, so we get some squiggles going here. Yeah. And so to me, I thought it was going to zigzag. I thought we could see even the 120 level on the 10-year Treasury bond. As it pulled back, and we aren't. It's just like it's being bought. Every time it sells off, it immediately attracts buyers that bring it right back up. If this is a midpoint consolidation, and this technically breaks above the 122.5 handle on the upside, we could have a big rally in Treasury bonds underway. And I'm watching. Is it going to happen? I'm very curious.
Well, that would flatten the curve something fierce if all of a sudden bonds broke out and it wasn't because
and it wasn't
Fed was losing.
Induced.
Yeah.
So and that would is that a yield curve inversion if that happens?
I think it would be pretty darn close. That'd be darn tootin' close. Like we're already sitting at the 210s are sitting at 15 beeps or something like that. So it wouldn't take much of a rally.
Well, listen, I want to talk more about these things, but I want to save them actually for the top 5 things to watch. So why don't we move on and get Barton on here?
And joining us this week is Barton. Barton is actually, let me just tell you how I found Barton. I was on Twitter and I've often been really interested in the effects of QT and QE and what they have on the market. And it ends up being a very difficult and complicated affair. And I noticed there was this one fellow at Barton underscore options that was very, very, uh, let's say sophisticated, much more sophisticated than I. That's right, much more sophisticated than I ever was in terms of kind of analyzing the different effects of QT and keeping track of it. And I reached out to Barton because I was very interested and I wanted to understand where he was coming from. And he was gracious enough to join us. So without further ado, I'd just like to kind of say welcome, Barton. It's great to have you with us.
Thank you, Kevin, for the very nice introduction. And it's a real pleasure here to join you guys for this podcast.
So, Barton, why don't you walk us through in terms of a little bit of what you do? You were nice enough to send us some slides. So we're looking forward to kind of talking about QT and giving us your opinions about how they affect the market and whether they do or not, and how we as traders kind of look at that and time it.
So this is kind of a long story. I got interested in QE and QT partially from one of Kevin's earlier blog many years ago about finding a correlation between the market movement and the specific QE schedule when Fed was injecting money into the market. And that was a very useful tool because the QE schedule is known ahead of time and you can profit quite handsomely from that movement. But when QE came on, there was a very interesting period when people know QT is on, but market seems to have no reaction to it. And then market started to move pretty violently last year, starting in February after the XIV explosion. So it's getting.
Right. So on the days when when we had a big, just for people who don't understand, QT is quantitative tightening, QE is quantitative easing, and quantitative easing, and the post that, or the piece that you were kind of referencing that I wrote about way back when was that I looked at the quantitative easing, meaning the days that the Fed was buying bonds, and I looked at the stock market performance on those days, and I realized that there was a outperformance. The stock market outperformed the typical day. So when the QT came along, I thought, well, if it outperformed on the days there was QE, on the days when there was QT, meaning that the bond was coming due and the balance sheet was shrinking, the Fed's balance sheet was shrinking, we might get a situation where stocks actually went down. And so you're saying that during that kind of the last year, after the XIV explosion, we had a period when QT, meaning the days when there was the Fed's balance sheet was shrinking, we were finding the stock market was underperforming and selling off. Is that correct?
Exactly. And it lasts for quite a few months until early summer, all of a sudden it stopped. And then after the October sell-off, the liquidity or the QT effects and QE effects seems to be very pronounced again. So there was a pretty significant debate on whether QT is a psychological effect or it's an actual mechanical effect that impacts the market and driving the movement of equity as well as of some of the commodity trading. So it's an interesting question. I'm really intrigued by it and then spend a lot of time to dig out some of the details.
Right. So you went to levels that were way past what most people do, because the reality is that although the Fed has bonds in their portfolio that are maturing, there's also all sorts of other cash flows that the Treasury and the Fed are doing. And this is where I found your work so intriguing, because you were doing things about Fannie Mae, Freddie Mac, Ginnie Mae, Treasury coupon payments, and everything, and trying to come up with trying to determine whether all of these liquidity events were actually affecting the stock market. So why don't you walk us through your slides?
Yeah. So if we move on to the next slides, let's just take a very quick look at what's going on in the market and what could be guided or driven by the QT or the Federal Reserve balance sheet changes in the past year. So what you're seeing here is the S&P 500 daily charts, and if you just look at this overall pattern, you can very quickly see there is some kind of monthly pattern when the price goes up during the first half of the month, and then drop again in the second half of the month. So that repeated itself in February, March, April, May, quite a bit in June, and then it stopped in mid-July. And that was a boring period of time when lots of people were saying that QT doesn't matter anymore. But after the October sell-off, you can observe this effect again. It's a monthly cycle when the market movement is bullish in the first half of the month and then bearish in the second half of the month, which coincide exactly with the QT schedule. So that makes you wonder whether QT is playing a pretty significant role here. If you look at the next slides, so we're just talking about equity market. In the bond market, you can sort of see the same phenomenon, a little bit weaker. For example, the QT process have 4 large bond roll-off in the middle of the month for the second month of every quarter. So February, May, August, and November. And those dates and their months kind of coincide with a peak in the interest rate for the 10-year and 30-year bonds when Fed is withdrawing or rolling off these securities off their balance sheet. So that kind of also drive the market a little bit, not as much as the equity market. So I'm kind of in the camp that there is definitely some kind of mechanical effects that are coming from the QT, and that's why I've been looking very deep into what could be the possible transmission mechanism that causes this kind of movement.
Well, it's fascinating because it looks definitely like there was a pattern, and it's interesting that we saw that pattern disappeared for a little period on the equity market. Yet in the bond market, it actually seems just as pronounced. It just doesn't seem as big. And so, what do you think? What do you think? How do you think this is manifesting itself? And what do you think we as traders can look at to kind of get a feel for whether it's going to cause the next rally or decline in the stock market and the bond market?
Right. So the way I look at it, I think the QT or QE effects are the selling or buying pressure is driving the stock market via a intermediary, which is the capital market. And whether the impact is significant or not depends on how loose or how tight the capital market is, which you can track through a number of yield spreads between a variety of repos or commercial papers that's being traded every day.
So what you're saying there is that the effects of QT are determinant on whether the market itself is tight or not. Is that correct? Like depending on where the market is in its own cycle?
The capital market, where
That's right.
the banks and institutions use to borrow money overnight or over very short term.
So the question I have more, this is Patrick here, just asking the question, are there any big roll-offs coming up? Like, is there something we should be watching for here in the next couple of months where one of these key phases is coming up?
That's a very good question. So let's just move on to the next slides and take a look at what's going on right now, this month on Federal Reserve's balance sheet. This is what you're seeing here is a typical QT schedule. Basically, the Federal Reserve are doing balance sheet operations only 4 times a month. All 4 days are during the second half of the month. On the 15th, they typically do a MBS, mortgage-backed security roll-off. So these are the mortgages bundled into a tradable security marketed by Freddie Mac. So that's about 4.5 billion rolling off around 15th. And then on the 20th, there is typically a 4 billion roll-off of MBS by Ginnie Mae. Yep. And on 25th, there's a $7.5 billion from Fannie Mae. So these are about $16.5 billion per month. And there is another tranche of money of U.S. Treasury rolling off of Fed's balance sheets. Today, actually, we had $23 billion of U.S. Treasury, 3-year, 10-year, and 30-year T-bonds rolling off. And at the end of the month, there's a 6.7 billion U.S. Treasury maturing and rolling off.
So today we had 28 billion rolling off, which was a fairly large QT. So you would think that that would have actually caused the US dollar to rally and for stocks to sell off. Yet we're kind of seeing the opposite. And I think that you mentioned that there's another factor that we have to kind of put into play here to kind of get a feel for whether this typical QT is actually going to cause effects on the market. Why don't you tell us about that?
Exactly. So let me first point out a couple of things. Number one, this is not happening every single month. The large roll off in the middle of month only happens on February, May, August, and November. Usually, is end of a month, U.S. Treasury roll off is the biggest, and middle of month they don't have it on January, March, etc. But in addition to the U.S. Treasury maturing, Treasury Department tend to do a lot of other things in the middle of months. For example, they pay out interest payment on the 15th as well. And for today, the estimated interest payment is about $45 billion, which is far bigger than the roll-off amount we're seeing here. So that part is actually amounts to a quantitative easing, a QE event, injecting money into the market, and then usually should cause the stocks to rally a little bit, as well as commodity prices.
So that's what the part of your analysis that I think is just so great, because so you're looking at this, and a lot of other people looked at the quantitative tightening, and they said, "Oh, I see this 23 billion rolling off of treasuries, and I see this 4.5 on Friday. Therefore, this is going to be negative." And you're taking all this analysis to the next level and saying, "Okay, great. That's fine that we're seeing all this quantitative tightening on this side, but you're missing the part about the big treasury coupon payment, meaning that the interest that they're paying on bonds. And so on the whole, what we think might have been a QT event is actually a QE event, meaning that they're injecting liquidity into the system, which is why we might have seen the stock market rally so hard and the US dollar sell off. Is that correct?
That's exactly right. Also, I think there's something that we probably could get some cue of is the capital market and how tight it is. I think if you look at the commercial paper yield spread with respect to the overnight funding rate for between the interbank borrowing rate, it has been dropping consistently from the end of December through today. So that's also a indication that there have been a lot of money flowing in the market, in the capital market, and banks are very willing to lend each other money and use security that was considered to be too risky before as collateral to lend money. So that also softens the impact of QT in general.
Okay, so you're just saying that the financial conditions are loose, and therefore that'll mean that QT doesn't have as big effect as it might otherwise be the case. Is that correct?
That's right. That's right. And I think this trend has probably a couple of more weeks or maybe a couple more months to run through its course for capital market to be continued.
So you think we're in one of those periods that we saw basically from late summer to early fall last year where QT doesn't have any effect?
That's right. During that period, exactly the same thing happened. The capital market was extremely loose, and it was getting looser and looser over time.
So we almost... Sorry, go ahead.
Until the second half of September, when the conditions started to tighten again. Okay.
Well, Barton, before we get too technical and get all the non-bond traders' eyes to glaze over, why don't you just tell us why you think this works?
Okay. So here's an example of the balance sheet of the Federal Reserve as of this past Wednesday. And I hope this is a good example of showing exactly how, in an ideal environment, how the QT would work. So basically, every time the Federal Reserve adjusts its balance sheet, two things happens. We typically know one of the things very well. There's some security or treasury bonds or mortgage-backed securities falling off the asset side of the Federal Reserve balance sheets. If you go to the next slides, those are the white boxes I'm drawing on the left-hand side. But at the same time, the Federal Reserve also maintain a liability list, which at all time matches or is equal to the amount of asset they hold. On the liability side, exactly the same operation is happening, except for this time, it is the commercial bank's reserve being reduced. In other words, the treasury bonds or the mortgage-backed security that's no longer held by the Federal Reserve at this time is bought by the general public, either by the commercial banks or the private sector. And as a result, the same amount of money is falling off commercial banks' reserve account at Federal Reserve. So what's interesting here is that what I believe now is that the drop in the commercial bank reserve is the key driving force of the equity market and bond market that we have seen.
Yeah.
And in addition to the Fed QT operation, it turns out the Treasury can oftentimes either inject or take money away from the commercial bank reserve, oftentimes on exactly same day of the QT days we have been very familiar with by now, and causes a similar effect and making the market action much more complicated to interpret it.
Right, and that's what
All right.
you're talking about, the things about like the coupon payments or even just outright treasury operations. Is that correct?
Yeah, that's exactly right. And if you can move on to the next slide, let me just spend a couple of minutes to talk about what is going on with the liabilities of the Federal Reserve. And this might have some implication about when Fed actually stops QT, what's going to happen next. In general, the liability side of Federal Reserve has changed quite a bit from the pre-financial crisis in 2008 through today. A big chunk of it is the Federal Reserve bills, the U.S. dollars where we have in the circulation. Half of it is the commercial bank reserve here, marked in blue, and that's the part that QT and QE affect the most. There is a red triangle at the bottom of the liability. This is a account, basically the checking account for the U.S. Treasury Department. It used to be very small. It used to be only have a balance of between $5 to $10 billion before the financial crisis, but it has ballooned recently to the size as much as $420 billion. And when this account start to grow, it has the same effect of squeezing and shrinking the commercial bank reserve that we're going to talk about in a second. So
Right. Okay, so let's just stop there, Barton, because I think this is really important. The Treasury has an account at the Federal Reserve, and that account is just like a checking account that they can basically pre-fund things that they're going to spend on later. If I got it right, like it's basically an account where they might go issue treasury bills and that they're going to spend in the economy later. And when they grow that account, it means that they've issued more than they've spent, and that account grows.
That's exactly right.
Yeah, and it's really important for people to understand that this account is become much more volatile. And this is the part that you and I had a discussion offline, earlier in the week. And when I realized that how big this account was and the volatility in this account, it just made me think, we're all worried about QT, but this account's moving up and down by hundreds of billions. And it's really important for people to realize that this might be having more of an effect on capital markets than any kind of 10 or 20 billion dollars of QT per month, when this account is going up and down hundreds of billions.
That's exactly right. So if we go 4 slides forward, here's a diagram showing the effect of U.S. Treasury either growing or shrinking its checking account balance. Usually, there are 2 things that could increase the Treasury general account balance. either by the new issuance of treasury bonds or treasury bills, or through tax receipt from taxpayers, general public. In both cases, the effect on the Federal Reserve's balance sheet is the commercial bank reserve shrink, marked by this pink box, and the Treasury general account grow by the same amount, by that pink box underneath.
So either way, it's when the general account, the Treasury general account increases, it has the same effect as a QT.
Yes, and from the perspective of the commercial banks, there is no difference between Treasury taking money in, withdrawing money from the market versus Federal Reserve doing QT.
So, Barton, I have to be honest with you here. After we had this discussion, I went and talked to some different economists, and there's a lot of debate about whether that's actually correct or not. And obviously, I'm more in your camp. I tend to believe that it does take money out of the system, and I'll tell you why, just kind of briefly, and to think about intuitively. But I'll just kind of, after I do that, I'll tell you what they think. So if we think about the government, let's say they were going to go out and borrow $1 trillion to spend. They were going to do a big infrastructure project, and they would go out and issue $1 trillion of, some sort of bond. And then they said, well, we're not going to spend that for a year. We're going to issue all these bonds, but we're not going to spend it for a year. I argue that money comes out of the private sector because everyone goes and buys those bonds, and then it doesn't go back into the system because the government has yet to spend it. So in my thinking, I'm thinking that it's a mismatch. Eventually, the system will be kind of equalized when the government spends that. But in that 1 year between the point where they kind of issued the bonds and they spent it, it's been a withdrawal in the system. Now, the true kind of wonky economist nerds will tell me that it doesn't matter, and they'll give me all these reasons. But I'm kind of in your camp because I think that if we go look at the effect that the Treasury general account moving up and down has had on the stock market over the past kind of a couple of years, I think a lot can be explained from that. Like, do you have a chart for us on that?
Yes, I actually do. And thank you for the vote of confidence on this theory. So if we go to the next slide, that is the daily variation of the Treasury General Account. I'm just going to call it TGA from now on. This account, as you can see here, can fluctuate by hundreds of billions of dollars over a short period of time. For example, 2 weeks, around the time of April, when the Treasury taking in the personal income tax payment from a lot of people, as well as the period in early December. That's usually the time the Treasury pay out a lot of the federal contract payments, which I believe can be a significant driver for the center rally that we have seen in the past few years. So this is a fairly large fluctuation. The month-to-month fluctuation sometimes exceeds the QT we have seen by 5 to 6 times.
Right. So everyone's sitting here worrying about QT and missing the fact that this TGA account is going up many multiples of QT. It's in and it's up, and depending on where they're doing. And you're saying there's some seasonality. You can see that every end of every January, there's a huge, like, it goes down and then it spikes up going into the year end.
That's exactly right. Because the January, and we're in that right now, is a time when the Treasury pay out the personal income tax refunds. In fact, next Wednesday and Thursday, I'm expecting about $40 to $50 billion of tax refund being paid out. And that's a cash injection directly into commercial banks, turn that into bank reserves, the most potent type of liquidity a bank can hope
right,
for.
Which might mean that the stock market has still got some legs under it yet, if we think that this liquidity is going to affect it.
Yes, exactly. If the liquidity can affect the market, it will probably trigger another mini rally.
So now, am I right? Can I just interject
you can go
here?
ahead.
So I see that spike coming there in April. Is that mean that if we see something similar to that this year, that's where the real liquidity drain could come in?
Yes, that's the April 15th liquidity crunch from the tax the personal income tax payments.
Right. So Barton, you have a slide. I'd like to show it that shows this account over the last couple of years. Is that correct? Like that. Can we keep going a little bit?
Yeah.
I think, do you have another
Yeah,
one?
so this is the chart that shows the SPY prices versus the TGA account from February after the XIV explosion through mid-November. And you can see here there's a trend starting after the March FOMC meeting, which is the red dash line plotted between March and April. After that time, there is a significant market weakness coincide with an increase with the TGA balance. And they state this anti-correlated movement. So TGA goes up, market goes down for quite a bit all the way into mid-July.
So Barton, as I mentioned, after our talk earlier this week, I got very interested in this Treasury General account, and I've been doing some work. And so here's the chart of this account over the past decade. And it's a complicated affair in terms of things changed. And at the Great Financial Crisis, they used to use a different account, and then they started using this one. And then there was some. I guess you were explaining to me before about how they allowed this account to run higher because of the debt ceiling, and they wanted to have an average account, this balance to be higher, so that they could run it up if in the case of the Treasury debt ceiling. Like, why don't you just tell me a little bit what you just said in terms of what you explained to me, why the Obama administration allowed this account to grow so high?
Exactly. So before the debt ceiling became an issue, the Treasury General account has been at a relatively low level, typically around 100 billion. But during the debt ceiling debate, Congress added a condition in the debt ceiling to say that Treasury cannot run up the TGA account balance to the level that exceeds its average value to save up some rainy day funds in preparation for debt ceiling. So that was a problem that caused a lot of issue for the Obama administration. So after the debt ceiling was resolved in 2013, the Treasury started to just run up this average balance to a higher level so that in the future, there will be a few more months of spare time for them to deal with debt ceiling.
Right. So now, and what they did, they ran it up, and then all of a sudden Trump got elected. And not only that, Trump got both houses. And Mnuchin comes, and what does he say? He says, well, there's no reason to worry about the debt ceiling anymore. I'm going to go and I'm going to like run that back down. And so you can see in 2016, that was 400 billion. And in the space of what was that, 1 quarter?
1 month.
He ran it all the way 1 month. He ran it all the way down to 2000 to almost zero. Like it was 25 billion or 50 billion. So if we kind of think about this, and if we believe that this is a QE, because we believe that kind of increasing this account is a QT, if we believe that this running it down is a QE, I view it as more like the Fed had it, or the Treasury had its foot on the brake and they pulled their foot off the brake. But it could explain part of the reasons we got such a massive rally after Trump was elected.
Exactly. And also the volatility was super low throughout most of the 2017, partly because of this.
Right. Then let's talk about 2018. 2018 comes along. No longer does Trump have both houses. And now all of a sudden, he's worried about the debt ceiling. So what does he do? He increases this account again. Not him, Mnuchin.
The account balance went up from about 75 billion all the way to 400 billion in the first quarter of 2018.
Right. So I believe that could explain why the last quarter of 2018 was so ugly for risk assets. I think that this running up of this account was in essence stealing liquidity out of the economy, and it was a 400 or 350 billion dollar QT.
I believe that has a significant impact. And then the highest TGA account balance is roughly around the time of December 24th, right before the Christmas.
Right. So it coincided with that. And so if we're correct, and I don't know, what do you foresee? Do you think that Mnuchin's going to leave the TGA balance here? Do you think he's going to let it run back down? What do you think is going to happen to it? And what do you think that means for the liquidity in the system?
He has already communicated through the Treasury refunding announcement that he will run down the balance to about $320 billion at the end of first quarter, and it will be down to 300 billion at the end of the second quarter. So we will see less of a liquidity crunch from Treasury, but I still think we're going to have quite a bit of this up and downs, $100 billion swings because of the Treasury payment streams.
So now, do you think that QT is something that we should be watching over the next little while? And if not, when do you think it's going to matter again?
Probably not a significant factor for the market for the next 2 or 3 months when the Treasury is running down its TGA account. But I think in the long run, anytime when the capital market is tight, the QT effects may show up again, not in the same way as we have seen in the 2018, but in the way that as the Federal Reserve gradually rolling the mortgage-backed security into Treasury bills, T bills, or T notes, you could see a similar effect on the bank's reserve balance and their liquidity coverage ratios. Those things are still there, and they could probably exert some downward pressure for a few years.
All right, Barton, I want to move on now, though. I want to get to the tales from the trading desk. And we asked you to come up with a great tale for us for something that you experienced or something that you think would be of value to our listeners. So, what did you come up with for us?
Thanks, Patrick. Since I am a option trader, I have some interesting experience with the vol complex trading last year during the February XIV explosion. Some of the option trader may have experienced this, but I think it's useful for people to know that there are additional risks when they enter into these positions. So I've been trading UVXY puts. That is the 2x leveraged VIX long ETFs that people have been shorting for a long time since 2012, 2013. I've been trading that for a long, long time, but I got bitten by it twice. That were very memorable. So the first time I got bitten was, I think, in 2014, which is a relatively safe period of time of shorting VIX. And I had a trip to Cancun during the spring. For some reason, coincided with the time when UVXI went reverse splitting because UVXY has been decaying exponentially over time. And one thing I didn't notice or I wasn't aware of is my brokerage at the time did not differentiate the price of the option before and after the reverse split.
Oh.
After the reverse split, when I was in Cancun, all my stop loss order, I put it there. I never thought it would be executed. All get executed in one night, like the morning before
Wow.
after UVXY got a
Oh my
reverse
God.
split. I wouldn't name the name
Oh
for the
man.
brokerage, but it was pretty painful, especially when you were traveling in a foreign country. So that's something I learned.
So you had stops on the UVXY, and then when they split, your broker didn't adjust all your prices, and so then you just all of a sudden
Oh, that's
all your
brutal.
options got stopped
That's
out.
right. Yeah. Well, so what happens for these ETF that undergo frequent reverse split and splitting is when that happens, the old options will be there, but they will create new options for the new shares, the
Yeah.
new prices of the ETF. So they used to be 100x, now become 20x because they did a 5x reverse split, right? But sometimes the brokerage
Right.
software did not distinguish the price between the old options and new options and the underlying price, etc. So the
And that happened
That
to you
happened to me
twice.
once, and I learned my lesson. Never
Oh,
do
okay.
a stop loss order on an ETF that either reverse split or split.
Right.
So the second story about
Yeah.
UVXY was actually a week after the XIV explosion, and
The
yes, exactly.
Volmageddon.
I completely was uninvolved in that because I learned my lesson in 2015 during the Chinese yen depreciation thing. That was a pretty painful time to shortfall as well. Many people probably didn't know, but I
Right.
learned my lesson that time. So after the Volmageddon, I thought, okay, it's probably a good time to short Volt again because Volt was so high. And so I bought some UVXY puts, but I didn't. I never thought about that. ProShare could announce that they're going to reduce the leverage ratio of UVXY overnight, and also reduce the leverage ratio of SVXY overnight.
Wow.
So that was a
Yeah.
big buy.
So yeah, because vol collapses, right? Because you go from having something that's 2 times to now 1.2 or something, and so your options are based upon a volatility that's twice the underlying, and now all of a sudden they go to 1.2,
Yes, your
and you get
extrinsic value
schmooked,
just
right?
shrink by 40% overnight.
Wow.
Yeah. Yeah.
You know,
It's just listen, trading UVXY is just it's for the pros
right.
only,
It's
and even the
like
pros get burned.
I have a lot of members that always ask me, can I trade volatility? But I always say to them, you got to save that for the pros because you're talking about a derivative of a derivative of a derivative that you're trading, right? It's not like trading on an
Yeah.
underlying equity, and so you have to have a certain degree of sophistication to understand all these pricing risks that come in with these.
Absolutely, and not only you need
Yeah.
to read the prospectus very carefully, but also you have to think about the unthinkables that might
Yeah.
happen in an extreme event.
Well, yeah. Who would have thought they would have ever gone and done that, gone for the stops
I
like they
wonder
did with
whether
the
that
XIV?
broker
Yeah,
It's
it
was on the
is.
crazy.
other side of that deal.
It's not.
Uh,
Anyways, thank you, Barton. I just want to say thank you for coming on and explaining to us all about QT. I think that your work is invaluable. I think that people, if you have any interest at all about kind of understanding the plumbing behind the financial system and how that might affect markets. And I'm a big believer that it does. And it's only getting more and more complicated, but your work has been invaluable and kind of for me in terms of understanding how it's moving. And they should definitely give you a follow on Twitter because you're so generous with your spreadsheets and all your information on Twitter. You post it all there, and you're doing the whole kind of capital markets community a big service. So where do they find
If
you,
they
Barton?
want to see the up-to-date information about when and how much QT might impact the market, they can follow me on Twitter for the handle Barton_options on
oh,
Twitter.
perfect. Well, yeah, you know what?
Okay,
Thank you very much for
that's
sharing
great.
all of that. And listen, all of our listeners, you got a new Twitter handle to follow. There you go. Kev, it's time for This Week in Trading History. What do we have in store going back 20 years ago?
Well, it's hard to believe that it was 20 years ago, a long, long time ago in a galaxy far, far away. The Bank of Japan cut rates for the first time to 0.
Yeah.
And I remember that, and I remember what a big deal it was and how everyone was worried about inflation, how they thought this was going to set off the hyperinflation, and here we are 20 years later, and Japan has been mired
No sign of hyperinflation.
Yeah.
This is the same scenario as you thinking inflation is going to rear its head in the rest of the world. Like we're gonna be doing this show 20 years from now, and you're gonna still be saying the inflation is coming. It's
You know what?
Just, it's long term.
I hope in 20 years we find a beer sponsor you like. So let's go to the chart. Let's pull up the chart just so I can show people. This is the Japanese overnight rate. And you can see that going into 93, 94, 95, as the bloom came off of the Japanese stock market and that bubble deflated, they desperately tried to cut rates, but they couldn't cut them fast enough. They brought them down to 50 beeps where they stood from kind of 95 to 98, and that still didn't do anything. And then in early 99, they bit the bullet and they took it down to 0.
Yeah.
And what's interesting is that they spent 2 years at 0 and then thought, okay, maybe it's time to raise them. They raised them to a whopping 10 basis points, lasted another year and a half before they had to go back to 0. Then again, in 2006, they just gave it a run. They tried to get it up, and they got it up, what is that, roughly 50
About
basis points?
50 to 75 basis points, yeah.
I think it was 50 basis points they made it there. They lasted 2 years there. So during the 06, 07, market madness in the U.S., where everyone and their dog was speculating on real estate, and there was absolute, things were running so hot that we hadn't seen since the dot-com bubble. The Japanese economy managed to, the Bank of Japan managed to raise a whopping 50 basis points. And then, of course, what happens, the great financial crisis happens. We're back down. This time, I think they left it slightly above 0, realizing 0 was not the best number. And then in 15 and 16, when the Europe went negative, they followed them on that stupid path of negative interest rates, which I think is just ridiculous and dumb. And I know you look at this and say this is the inevitable kind of conclusion.
This is the inevitable. Until MMT is with us, this is the inevitable conclusion. I mean, look, there could always be the redefinition of money and the change in the way our monetary system works. And at that point, we redraw the rules. But until they're redrawn, this is going to be what the rest of the world will look like.
Okay, so Patrick, you think we're going? Are we going back to 0 at the U.S.
Yes.
in the U.S.?
Yes.
Okay.
Yes.
And did you see that the I think it was the San Francisco Fed last week published a paper where they once again broached the subject of negative rates? They're like the Fed's getting us ready for it.
The seed is being planted. And
so stupid, just so dumb. Negative rates are dumb. We've seen
it's the flaws of our monetary system, and you know what? The thing is that there's going to be a point when our monetary system, those flaws will be fixed because we'll redefine everything. But until the rules change, then 0 and negative interest rates are a feasible possibility in the U.S. in my mind.
Well,
I don't want to say it's certainty, but I definitely think it's on the table.
Yeah, I think it's on the table, but it shouldn't be, and that they should do fiscal. And everyone always says, but Japan did fiscal. What they don't realize, or not that they don't realize, what I think too many people don't take into account is that every time Japan's economy got going, they started worrying about budget deficits and decided that they were going to raise taxes. So every rally in their economy was met with an increase in taxes. And so they never actually had a situation where they worked in concert together. Now, you might argue that since Abenomics that they've done it together, and even then they've tried to they've raised taxes at certain points. I do agree with you that one of these days people are going to get sick of that kind of idea, and they're going to just spend until they create inflation, and then that's going to be a different ball game.
So
but
I want to.
Sorry,
I want to change the topic just slightly to not just rates, but about the actual yen, because there's a number of smart people that always observe that the yen has been considered a safe haven currency during periods of crisis and things like this. But for everyone that's talking about the U.S. dollar and it losing its reserve status and all this stuff and making the dollar this boogeyman, I actually think it's the people that think the yen is a safe haven that are going to get the big punch to the solar plexus at some point.
So I completely disagree with you, Patrick.
Yeah, I know you do.
So nobody actually thinks that the yen is a safe haven, except for the fact that it rallies in times of stress because it is a funding currency. So it's not so much that people are buying it; it's that people are short it, and they're covering. Okay. And so it's a fine distinction. But
all right, okay, you got me. But in general, though, that trend exists on the chart pattern, which is in the past.
Yeah. But it's not. But because of its nature as having these low rates, it is a funding currency, and it's also like it runs a positive trade deficit, and there's other reasons for it. And Japanese often will go, because of their low rates, they will go abroad, and then in times of stress, they'll bring their money back. So it's complicated, but I don't think that anybody is saying, "Oh, I'm scared about the market, therefore I'm going to buy yen," except for the most sophisticated of traders, who will realize that this tendency for the yen to rally. But it's not because they think that the yen is a great investment at that time.
Right.
Yeah.
Okay,
that's
fair
my
enough.
2 cents.
You know what? I accept that. All right, let's move on.
Okay, so what's next? WTF clip of the week? Okay.
Kev, time for WTF clip of the week. And let's make it a little more lighthearted this week.
That's right. I went down a dark road last week.
Yes, you did. I wasn't there. You said I'm gonna put something out there that represents.
Oh, there he goes. He's abandoning me. No, not partners when something goes wrong. I can see it already. So we decided to be a little more lighthearted, and
good topic. Bill Gross. I thought it was such a great thing. So anyway, let's watch it. No?
Okay, sure. Let's give it a watch.
Well, unconstrained has come to mean basically go anywhere.
Yeah, enjoy that wine. Hey, there you are.
Well, hi, do I know you?
No, but that's where you are. You're there. Hey, viva Las Vegas, baby.
The total return concept that I developed was really developed on a concept of measured risk taking. It's what I learned in the days of blackjack. You didn't put a lot on the table. And
do you mind if I join you?
Not at all. Game is blackjack, gentlemen.
so, for the past 3 or 4 years, the negative trade for unconstrained has always been Germany versus the United States in terms of a spread. 10-year German bunds started out in my portfolio at 190 basis points over, and they're now 250 plus over, and so that's been it's been the big decider, and probably one in which I shouldn't put too many chips on the table.
$10,000 minimum bet. King for you, sir, and a 3 for you. 17.
Hit me.
You have 17, sir.
I like to live dangerously.
Well, this is critical, Bill, and this goes to the hedge funds and so many underperformances of hedge funds, depending on whatever you want to look at with the statistics. Was the underperformance that you faced in the last year with unconstrained, was it because you were not diversified? Is it the phrase unconstrained gets you into a focus where the bets are too big, to go back to Ed Thorpe?
4. 21.
Yeah, I think it did for me, and perhaps for other unconstrained funds too, if only by the nature of the term. The old Ed Thorpe terms, the gambler's ruin concept, basically said you could only bet 2% of your total capital, and certainly I had positions in unconstrained that were significantly more than that, especially the German-U.S. Treasury trade, and that.
5. I'll stay. I suggest you hit, sir.
I also like to live dangerously.
As you wish, sir. 20 beats your 5. I'm sorry, sir.
Well, I won't lie to you. Cards are not my bag, baby.
Oh, you know what? Mike Myers is just great, and he's a proper Canadian.
Yes.
And he's a Toronto Maple Leafs fan, which makes him
stupid?
even that much closer to my heart. Closer to my heart.
Although I guess you know what, he was a Toronto Maple Leaf fan when there was no reason to be a Toronto Maple Leaf fan. Nowadays,
Oh, so was I. So was I.
I don't think you should be bragging about that. You know, I'm a Winnipeg boy, so go Jets. So let's talk about Bill Gross. He recently retired, and I wrote a blog piece about it, and that's what kind of inspired me to do this mashup of Bill Gross and Austin Powers. And he was busy talking about sizing bets correctly and how he might not have done that as efficiently as he should have with his German Bund U.S. Treasury spread bet.
Right.
And before I go and say anything too bad about Bill Gross, I have a mea culpa to say. I have been as excited as Bill has been about this trade over the past couple of years.
Yes, you have.
And I have been as disappointed as Bill has been. So I have, those who live in glass houses shouldn't throw any rocks. And
I'm not throwing rocks at you.
Yeah. So I have, this has been kind of my worst trade as well. And it just seems to, I really think that. Sorry, go ahead,
first
Patrick.
of all, explain the trade.
Okay, so why don't you go to the next chart? Why don't we go to the next chart? So there's the 10-year Bund trades at roughly 15 basis points, and the 10-year U.S. Treasury trades at, 275 basis points or whatever it works out to.
Right.
The spread between those two is the U.S. Treasury Bund spread. And Bill believed that it was wide, and it was the widest it had been in many, many decades, and that it was going to narrow. So he went long U.S. Treasuries and short Bunds.
Right.
Well, the trouble is that Bunds have gone, only one way. They continue to go up, up, and up, and up because of the reasons that we discussed earlier with the European market. And not only that, although the U.S. Treasuries have been rallying lately, let's not forget the past 2 years have been actually a pretty negative market, right?
Yeah.
Like it's gone down and in terms of price and up in yield. So this trade has gone hugely against Bill, and he just fought it every tooth and like every little bit. And every time I saw the guy on TV, he was talking about this trade. He loved it, and I love it too. And if you think about it, let's just kind of think about it logically.
Stop it. Don't use logic here.
Go
on.
Okay, but if you think about it logically, I know that's hard for you, Patrick.
Yeah, I know it's very hard.
Do you really think that the U.S.-German inflation rate over the next 10 years is going to be 250 basis points every year lower than the U.S.?
No.
No. So that's in essence what you're betting, assuming they both don't go bankrupt, like nobody defaults.
Okay, but what if you just accepted the fact that Europe, and particularly Germany, has already turned Japanese?
Okay,
and
I completely agree with you, and that is what has happened. And that is why Bill got crushed, because in essence, what's that line about that you can't really call yourself a macro trader till you lose a small fortune trading JGBs or a large fortune. That's in essence, we go back to 20 years ago, the Japanese lowered their rates to zero. Well, for the next 10 years, every single macro trader kept shorting JGBs, expecting a huge amount of inflation to come and for the Japanese bond market to get blown out of the water.
Yeah, and they do these kind of pairings, and it never happened.
Yeah, Japanese bond market was one of the best performing markets in the world. You could have made yourself a fortune going long. I saw something that the Japanese bond market over the last 10 years had a better return than buying Microsoft at the day of their IPO and selling it at the top. It was some crazy statistics like that. It's like it's been
that's where the guys like Alex Gurevich are talking about that the big rally in treasury bonds is still ahead of us. It's this view that it's the Japanification of the entire world, and that everyone that's so super bearish these bonds is going to miss out on this epic move as interest rates go to zero freaking right across the board.
Well, if that happens, then Bill Gross will end up being right, because I think that the 10-year German Bund will stay at zero. And then what you'll find is that the U.S. 10-year note will go down. And so there's a long
Well,
history.
interest rate will the interest rate will go down.
That's right. I'm sorry. The yield will go down. The bond will go up. There's a long history of very famous kind of hedge fund managers or managers tapping out at the bottom of cycles.
Yeah.
So you have Julian Robertson tapping out at the bottom of the cycle. You have, I think someone mentioned to me Andy Hall tapped out at the bottom of the crude oil cycle. It's very, very easy for these guys to just kind of say, that's it, I'm giving up, when they've had enough. Like, it's just like, I can't take this anymore. And this is what when I wrote my piece, this is what it felt like to me with Bill Gross.
Almost like Mark Hart on China.
Yeah, good old Mark. Bill Gross wears his shoes, though. So but this is even longer term than that, because Bill Gross has been pounding pounding the table on this trade for forever. And to me, I looked at it, and it seems to finally be working. Like it's he didn't top out at the exact top. It was trading 280. It's down to 250. And if I had to guess,
are you doubling down here? Are you doubling down?
Well, I don't have it on right now, but I definitely, if you made me be long or short this thing, I would be short it, meaning like going the same way as Bill Gross. And I think the fact that he went and tapped out is one of the best signals around. And I even said it in my blog that if it's nothing personal, Bill, if I held a position for 2 years and then I finally puked out the position, I would be telling all my pals to put it on.
Yeah,
that's
definitely. But in terms of, for our listeners that would want to even consider putting this type of a trade on, I mean, there's no difference in the sizing. You're just basically doing 1-for-1 contract because it's
no.
duration.
So if you go to my post, you'll see that I actually put the actual hedging ratio. You do need to make sure that you're basis point neutral. So you need it to make it. You need your position to have the same basis point value. Now let's just go to the next chart here.
Yeah.
You'll see it over a longer term. This is it since 1989.
Yeah.
And that's what. How
Bill
many
Gross
years
was
ago?
looking for that 89 to 92 style move, and
It hasn't come
yet.
Yeah.
Yes.
So good old Bill. So anyways, go read my post. There's some funny other stories about Bill and his debacle.
For our listeners that are just double check, you go to the macrotourist.com website.
Yeah.
And
We'll put it in the
Kevin's
weekly
blog.
email so that people can have a link. It's
Absolutely.
got some fun things about Bill, and you know what? He seems to be a good sport. I'm sure he's going to love our Austin Power mashup.
For sure. All right, let's move on. Kevin, I wasn't here last week, and so you and Tony tackled the top 5 things to watch next week. So why don't you take us through the top 5 things you guys were watching?
Well, let's go with number 5, the German 10-year Bund. It ticked below 10 basis points, and we asked, will that get worse? And I think you have the chart there for us, Patrick. So far, no. It's hanging around 10 basis points. It was a pretty boring week in terms of German Bunds, but at the same time, it ain't ticking back up.
Look at that. 60 basis points down to 10. Wow.
And about to go negative at this rate, right? Like, it's just just dumb. It's so dumb. And, when I wrote my piece, a lot of guys were telling me that I should actually trade German swaps because the reality is that there's not enough collateral for the German Bunds, and this is why we're getting this sort of kind of anomaly. At which point I told them that I'm just an odd lotter and I'm not trading with ISDAs. But anyways, I really truly think that everyone should have the German 10-year yield up there, because to me that 0 is a line in the sand. If that thing goes negative, and I realize the rest of the curve is negative, but if that 10-year goes negative, the amount of pain that creates in the banking system and in pension plans, the European economy just can't handle it. So it's just dumb, and put it up there. Maybe put it up there with Deutsche Bank as well, because that's another stupid one that just seems to have trouble.
But by the way, very quickly, Deutsche Bank. Let's take a look at this right here. So a question I have for you. Okay, like it popped a little bit. All European banks popped here on Friday, just a little bit. But you know what? Do you think that it merges? Like, I mean, ultimately, I personally am not certain of whether or not Deutsche Bank in its current state is going to exist. I don't think it's like zeroing like Lehman, but I just their funding costs just keep rising. They're just in this feedback loop that just is what causes all financial institutions to dissolve.
Yeah.
How do you think this plays out?
Well,
I know you were bullish, but
I know, and I was wrong, bullish and wrong. So the question is, how does it resolve politically? And I still contend that over the short run, the worse that it gets in terms of French people rioting in the streets and all sorts of problems, the quicker Brussels will be to come up with something where they either allow Italy to to run a higher deficit, or they figure out their form of MMT. So a lot of people look at the negative kind of social kind of. I don't know how to explain it. Maybe they look at the fact that it's escalating and they say that's the reason to sell Europe. To me, that just means that we're closer to the point where they break. And then when they break, I'm pretty convinced that their solution will be to print and to spend.
Yeah.
And so at that point, I think that it goes higher. And therefore, when I see the French rioting in the streets, I just think to myself, well, we're probably closer to that endpoint. Now, the real question is, can you sit through it when it happens? Not sure. It could get a lot uglier. But
look,
I don't know.
I believe we're in that phase. That's a global bear market that is playing out. On the other side is for sure a buying opportunity, but I guess it's all about the timing here, isn't it? Yeah. It's just it's how to get there. So now, listen, number 4, you guys are talking commodities. What was on your mind?
Well, that was Tony saying that he noticed that just like in the same spirit as Bill Gross retiring, Goldman was exiting the commodity business. And he was wondering if will commodities finally get off the mat. And there's been really no signs of it. If you pull up the CRY,
no, you know what? I've got here just the Barclays commodity basket here, ETF or the ETN, sorry. And but you can see I had a little uptick here today, right?
Well, today had a good day, and I don't know.
You know where it was? Look at what freaking's been happening to gasoline futures.
Oh, there you go.
What a breakout!
Actually, that's a good-looking chart. Even for a non-squiggle guy like me, I can say that's a good chart.
But the thing is that it's been dogging it for so long. Oil's been ripping higher, kind of playing, and gasoline's been just trailing behind, doing nothing. And suddenly, boom, it's off to the races. But that's not the case for wheat and things like that. But if you look at wheat futures, it seems to be kind of rolling over here, doesn't it?
It's just there's really on the whole CRB is not really taking off. And if you go look at the CRB raw industrials, which is actually the stuff that's not traded in the futures market.
Yeah, I don't have a chart on that.
Yeah, that's actually ticking at new lows. So to me, I don't think we're getting the pop that we were hoping for in terms of Tony was hoping for.
Look at oil here. Look at oil. It's maybe we're heading to 60 here. Anyway, it's interesting. But here's my opinion, if I can share it with you.
I'd love to hear it, Patrick. We missed you.
My opinion is that we're at the turn of a business cycle, and the commodities are going to get the tailwind from central banks starting to reliquidate the system. And therefore, I just think that the commodity turn is just a little early. There's going to be an amazing opportunity to buy commodities, but it might actually be 6 months or a year out from now. What I think you have to have it on your radar. You got to be ready to buy it, but it's just too early. That's my call.
Well, there you go. You guys heard it. So let's move on to number 3, FANG. Does it drag the whole market down? Why don't we go through some charts here and see?
Which one you want to look at, Facebook?
Well, let's just start with Facebook.
It's muddling after the earnings gap, but you know what? I sort of agree with him. I think that generally the FANG stocks had their day in the sun. I mean, even look at Amazon, right? It just doesn't seem like it's not participating.
Yeah, and how about Apple? I think it didn't have a very good day considering the market was flying.
Yeah, it's just muddling.
Yeah, it's
muddling
muddling.
along.
Yeah.
Netflix has been okay. I mean,
That's
but
probably the
Netflix
only
is
one that looks.
that's probably been the best chart. Yeah, I mean, Google's been
So-
rising. It's just not where the money's flowing. It's not where
I
the
agree,
money's flowing.
and you know what? It's interesting. I saw a rumor today on the Twitter that Germany is considering putting a 15% tax on online advertising revenue.
Oh, I didn't.
So
hear
I think
that.
Tony brought up that whole idea that sentiment and from governments and even the public is turning against these guys. And I tend to agree. I don't think that FANG's going to lead the rally if we do have a rally from here. And the market screamed today, and those stocks they kind of look nothing. Okay, number 2, U.S. dollar. Will it finally break out in a direction? Let's pull up the Dixie and have a look here and see what it's done. We spoke about it earlier, it actually has continued to rally. It broke out of the range earlier.
2 days of muddling, but I mean it's pressing that high. It's pressing that high. I think it's going to break out. I do.
Okay, and then
the
real question that everyone's on everyone's mind: will Mrs. Big Picture Trading let Patrick back in the house? So we want to know, did she let you back in?
First of all, I had a great trip out in San Francisco. It rained every day. It was miserable. It was a great trip.
It's like Vancouver.
It is. It's the West Coast thing, right?
Okay.
But you know what? Luckily, she didn't recognize that when she changed the lock on the front door, that she left the back door lock out in the garage, and so I did get back into the house. Now trying to smooth things over, but it was a close call. But I'm back in.
Okay. Do we have time for, what you're laughing about San Francisco weather makes me think of a really great Vancouver joke.
Go for it.
We have time.
Go for it.
Okay.
Yeah.
So this fellow dies, and he's gone up, and it's time for him to be judged. And he's in this big, long line, and there's Satan at the end of the line. And what he's doing is he's taking everyone, and he's either sending them up to heaven or he's throwing them down into hell. And so the guy's sitting there waiting for his turn, going one by one through the whole list and stuff of people. And he notices that every now and then Satan takes one of the guys and he puts them off to the side. And so finally he's getting there, and it's almost his turn, and he's thinking about whether he should ask Satan anything. He decides, I'm going to do it. So he says, when he finally steps up and he says to Satan, he says, "Oh, excuse me, Dark Lord, before you judge me, do you mind if I ask a question?" And Satan says, "No problem, go ahead." And he says, "I noticed that you send some people up to heaven and you send some people down to hell. And there's other group that you put off to the side. May I ask what those people are about?" And he says, "Yeah, those people are from Vancouver. They're too wet to burn." So I'm going to piss off all my Vancouver.
You know what? Listen, they'll appreciate it.
That's right. They'll appreciate our Vancouver humor. So just send us all your Toronto jokes, Vancouverites, and we'll please read them next time. Okay, so let's go on to the top 5 things to watch next week.
All right. So for the top 5 things to watch next week. So number 5. Well, what I wanted to do is just touch on Canadian real estate. And one of the things I watch, it's not an official thing from the realtors. It's from the Zolo.ca site, but it's nice because they update on a regular basis. But here's some just charts of Toronto and Vancouver house prices being tracked on a regular basis through their stats collection, through the MLS. And what's interesting is that you can see that both Toronto and Vancouver prices have turned downwards. And I wanted to simply ask the question, is this just a blip from a seasonality perspective? Because this is usually a slow period in the real estate market. Or is this a sign that the cycle has turned? And we saw about a 15% decline in houses. I mean, at their peak in October of this cycle, it was about $880,000 house in Toronto. I mean, it bottomed out in January about 740,000, about a 15% drop. And right now, Vancouver continues to weaken. Back in February of last year, they were about 1.4 million a house. Just right now in February, they ticked down to 1.1 million, just about a 20% drop or so. So real estate prices turning. Is this, what do you think? Is this for real?
Well, as much as I love our Vancouver friends, they've been benefiting from the Chinese expansion. And you know me, I'm a huge Australia kind of bear, and because of their proximity to China. And I think Vancouver is also going to suffer. So I wouldn't touch Vancouver real estate with a 10-foot pole. In terms
But you're
of
buying the dip on Toronto, right?
Well, I don't know if I'm buying the dip.
Because there's no China money coming to Toronto. It's just
well,
Vancouver.
I know. Of course, there's China money coming to Toronto as well. I just think that the amount of overvaluation in Toronto versus how much the economy can support is much different. So I think Toronto is much more realistically priced as opposed to Vancouver. And it's not that I'm bullish, so don't get me wrong. I'm bullish on neither. I think that you'll be lucky for these to, not decline in real value. You've been a huge bear on these things. You kind of think that there's going to be a 2008 style crash. I'll take the other side of that trade.
No, what are you putting words in my? Listen,
come on, it seems like that.
Okay. I'm bearish real estate, but you know what, you made the point when we had this conversation in the past, and you made the point, it's all about currency. I mean, the Canadian dollar, listen, if the Canadian dollar heads down to 70, 60 cents on the downside, then on a nominal price basis, real estate might surprise everyone and hold up. I think the currency trend is actually going to be important here.
I agree. And the real point is that the reason that the U.S. housing debacle was so bad was because they were the reserve currency. So as credit was destroyed, it was paid back, and it caused their dollar to rally, which made even more the whole cycle much worse. So so if Canada real estate has some trouble and gets into problems, then the Bank of Canada can just let the dollar go. And having said that, I actually think that's what's happening in in Australia. And you're going to see that Australia is going to be way worse than Canada, and that I foresee a point where the Australian dollar is going to be significantly lower. It will be the relief mechanism upon which this air comes out of the Australian housing market.
It was interesting because we recently had that interview with Grant Williams, and he basically was talking 50 cents on the Aussie.
I'm with him.
I mean,
I think it can happen.
Dude, that's a 40% decline.
Yeah, I think it can happen. I think that Australia is as much as I think Canada's crazy. I think Australia is Canada on steroids.
Yeah, I know. I know your love affair with the Aussie CAD short is going to probably go the way of the Boond trade. That you're going to be like Bill Gross a year from now on that Aussie CAD pairing.
Oh, sounds like fighting words.
I'm not in it, so therefore I'm going to hold you accountable for it.
Oh, that's good. You should keep holding me accountable. I do have that one on. I love that trade. I think Australia is going to have some troubles, and I think that shorting it against Canada is the best way to play it because it takes out all the problems about the U.S. dollar and the fact that they're both kind of commodity currencies. So it's basically a pure play to me
on China.
China versus the U.S., and I think that China's going to have more trouble than the U.S., and that's why I like Canada over Australia.
But China, everyone knows that China's in the shitter already. What no one realizes is that the U.S. is going to follow. I think the rate of change of the U.S. decline will be greater. We'll see. Okay. Anyway, number 4, Kev, what's on your mind?
So number 4 is the Shanghai Accord number 2. And this was brought to my attention by Mark Hart, the hedge fund manager that doesn't like wearing shoes for his Real Vision interviews. He was having a discussion with Brent Johnson from Santiago Capital, and I'm just going to read what Brent says. Brent says, I wonder if the many investors who favor Austrian school theory but also continue to proclaim that fiat currencies are about to strengthen dramatically despite enormous national debts, huge budget deficits, and extremely easy monetary policy realize what they are actually saying. And then I look and I see Mark Hart jumping in there, and he says, forget Austrian economics. geopolitics will drive the dollar lower. And this is the part that really got to me. He says, Mnuchin has stated many times he's negotiating with the Chinese on currency. I think a deal's already done. Plaza 2. Fed is in line.
Wow.
So what I think that Mark is trying to argue is that the Fed's flip-flopping, and many people have been kind of confused and wondering why the Fed so quickly flip-flopped. And Mark is kind of offering up the thought that it was part of a deal that Mnuchin negotiated with the Chinese. And the best way that I can kind of frame it in my head is that the Fed agreed to be easier, because don't forget, before that they were raising rates and causing all sorts of pressure in the global financial system. The Fed agreed to be easier if the Chinese didn't devalue their currency. And that's kind of what I think is what he's saying. Or he's even saying that the Chinese have agreed to strengthen their currency, because if we pull up the CNH, it's actually rallied over the last couple of months.
Yeah,
much to everybody's surprise.
Right. So there's your little rally that's happened in the last little bit.
Right.
And it's rolling over a little bit here. You know what? This is interesting because Russell Napier and others, the really smart guys out there, are arguing that the Chinese are just going to let their currency float at some point. And the natural price of the currency is much lower. I mean, this idea that this is, like, listen, Mark Hart has gotten it wrong numerous times. You think he's going to be right on this?
I don't think he's going to be right, but I'm intrigued by people who have different ideas and are willing to say so and kind of make you think. And I look at what his comment is, and I think this is something not a lot of people are talking about. And I felt like it was kind of important, and we should think about it. It shouldn't be off your radar. And I give it a low probability. I don't think he's right, but at the same time, I want to know about it. I want to think about it because there's a chance he is right.
Yeah. Well, you know what? That's definitely something to put on our radars and watch what happens here.
So let's move on to number 3.
Well, number 3, I wanted to watch the Canadian banks.
You just love Canada this week.
Today we're staying in Canada. Well, listen, everyone likes to talk about those Australian banks, and obviously the centerpiece of what everyone defines as the big Australian real estate bubble. But you know what? What's interesting is the Canadian banks. Obviously, look, you saw real estate in Canada turn. We talked about it, number 5, starting to turn down, and all the Canadian banks start their earnings next week. It actually starts with Royal Bank, and most of the actual Canadian banks are the week after. But Royal Bank comes out on the 22nd on the Friday, and it is the Friday, right? The 22nd.
That sounds
right.
right.
It is.
Yeah.
That's right. That's the 22nd. So on Friday, we're going to see Royal Bank's earnings. And what's amazing to me is this huge rally these banks have had in the last month. I mean, if you bought January and you held till today, I mean, you're up 10+% in one easy fluid motion, right? Actually, probably 15% there. And these banks have had this run. The question is that will the earnings 17% rise there. Will the earnings actually support this rebound, or will that be the catalyst to reignite a new distribution cycle? Do you have an opinion on that?
I don't know if this will be the actual earnings announcement that disappoints, but
It'll be the one after.
I am a believer that Canadian banks are going to struggle. And I wrote a piece about this saying that I like U.S. banks versus Canadian banks. I think the Canadian banks are in a situation where the consumer is much more tapped out. It's going to be difficult for them to find more ways to lend to them. I think that housing is turning over and not rising like it had been. I'm with you. I just don't see how you can get too excited about Canadian banks here. Yet, the prices continue to rally more. You just pulled up J.P. Morgan against Royal Bank, and it's Royal Bank's running faster.
But would you do a long short?
Yeah, for sure. I don't know if I'd do it against those two particular, but
you would do the ETFs, right? Like you
Yeah.
would go, let's say the Canadian XFN. Well, you have to currency adjust though. You'd have
Yeah.
to.
But I just, I really think that the Canadian banks are going to struggle. So as much as I'm bearish on Australia, I'm not quite as bearish on Canada. But I'm the same concerns I have about Australia are very prevalent in Canada, and I don't see how the Canadian banks continue this pace.
Yeah.
So I'm with you. I think that. One of these days, Canadian banks are going to disappoint, and I think it is an important topic.
And you don't think it's this quarter.
I don't know if it's this quarter. That's all I'm saying. I don't know.
Well, I don't know either. What we're offering our listeners is a speculation.
Yeah, but it's a definite potential for it to be this quarter. And
I don't think we put on a trade betting on it. But what I think the reason why I put it on the top 5 things is because I think it's important to watch, because if they start to disappoint already in this quarter, then this might be where they're rolling over, right? And so I let's watch what happens, and we can give everyone an update next week what happened on the earnings.
Sounds good. Let's move on to number 2.
So number 2, you were going to talk about an interesting pattern that you've identified on the S&P 500.
Right. I don't come up with anything on my own. I just look at other people's good ideas and I take them. Bespoke Investment, my good pal George Perks, posted this chart that shows the S&P hourly returns ever since the bottom after the Christmas Eve massacre till today. And you can see that a whopping kind of like almost all of it is actually being accounted for in 2 hours, meaning the 11 to 12 period and the 3 to 4 period. So the 11 to 12 period is often coincides with the closing of the European market, and then the 3 to 4 is the U.S. market. Right. And it's shocking. You could own the market for just those 2 hours and get almost 100% of the returns since that kind of bottom. At the end of last year.
You have to be a real intraday trader to be clipping that.
Yeah.
What's the second chart showing?
The second chart shows you the returns, going into the decline of the previous, September to December. And you can see that it was not quite the same. That you got the first hour was a positive hour. The worst hour was the 11 to 12 hour. And then the final hour wasn't very good. So it's not exactly the reverse image, which makes it all the more interesting. This is my theory behind this. It's that this rally is driven by large allocators. And whether those allocators are European or U.S., they're pushing it. And that's why we're getting that move at the end of the day, whether it be the European end of the day or the U.S. end of the day. And I think it's just grinding higher from these guys continually putting money to work in big, huge ways. And I look at this stats, and it doesn't give me kind of comfort. It gives me worry that it's just arbitrarily large funds getting put to work that the moment they walk away, we're going to start, falling back down. Anyways, that's me, but I don't know. That might be the bear in me talking too much.
You know what? I don't want to overread into these things. I look at the bigger cycle that we're in and when the market will turn as opposed to what part of the day to trade. But it will be interesting to see if this pattern shifts at some point, because it may be a sign that the personality of the market may once again be shifting. And so it'll be interesting to see.
It also could mean that by the time I figure it out and bring it to everyone's attention, that it's over.
That it's going to already be over.
Yeah. Okay, let's move on to the number 1.
So number 1, what I really wanted to ask was a simple question. Which one of these major asset classes is the one that's going to break out first? Because we have the dollar index winding up right up to this previous high. So let's kind of go through this, right? And so you have the dollar index winding up along its high, which is obviously equally corresponding to a euro that's on the edge of a cliff. and about to drop. And I love that Druckenmiller saying, or not saying, but at least I heard him say before, which is so true in my mind, at least the way I look at intermarket relationships, is that forecast me the direction of the dollar and I'll forecast you the performance of every other asset class. And so to me, this dollar trend is so huge. But what's interesting is we have so many other assets just at such critical levels, right? And what's interesting is, will crude oil follow through with a brand new breakout above 55, head to 60 plus? Because, I mean, that's a major input in inflation numbers. Or will we finally get a breakout in copper above the 285 handle, or will gold break out of this range and continue up to 1350 to 1380? I'm curious, and like we were talking about earlier, could treasury bonds break out of the sideways triangle range and really resume a new rally, or potentially out of the triangle breakdown? Which asset class will it be? Do you want to take a wager?
I don't know.
For the sake of entertainment, let's wager, like a friendly thing. But like, what's your intuition? If you had to pick one of these and that has the best chance of breaking out, dollar, copper, oil, with dollar being also the euro, or something like treasury bonds, which one do you think makes the move first?
I'm going to go with Druck. I'm going to say it's the dollar. What do you think?
You know what? I'm not going to say the dollar, because then all of our listeners know that they should short sell it right away. Fade these freaking market huddle fuckers that are just whenever me and you are in consensus, there's something to worry about.
So you want to say the dollar, so you guys should short it anyways.
You know what? I'm going to say treasury bonds. I think that this may go, that this may actually happen. So you know what? Let's watch. But to me, the macro markets have been winding up, and they haven't broken. And something's going to give, and one of these asset classes is going to be the first out of the gate.
It's
now,
like that Sesame Street saying, one of these asset classes is not like the others. Remember?
Except the rest will follow. Yeah.
Yeah.
I remember that. It's.
Yeah. So
Anyway.
I agree. The charts we're sitting here without much to say, because so many things are kind of in between and waiting to go one way or another hard. And I think that's kind of your main point, is that be on the alert for the move, because it's coming, and it's going to cause everything to go that way.
Right, Kev. Like, do you agree with me? But it's true. I mean, it's actually not really that disputable. When a macro trend occurs, it tends to last even 6 to 9 months when one of these big macro trends breaks out. And so when one of these major macro trends gets underway, that's the one move of the year. Think about it. There's 12 months in a calendar year. You're at best going to have 2 major macro shifts in a year. And so when one of these happen, you got to pay attention.
I agree. You for sure, because that's the one that you're going to make all your money on. You can sit around chipping and making some money on the other stuff, but the reality is, if you miss the big move, and when it goes and it continues, and it keeps going. Interestingly enough, we didn't talk about gold, but gold seems to be one of those ones that are kind of confounding people. Just keeps headed higher.
I did actually mention gold, didn't I? But I did put up this chart. But look at that breakout candle. Like, you know what? As a technical analyst, which we're squiggling here, you can see here that this is like a little flagging formation, no different than what we witnessed over here. And each time gold has done this, boom, it's off to the races. And you know what? Gold, if it makes this move, is got a date with this previous high. And the question really is, can it buck the trend of the dollar? This is one of the most interesting trends. Like, normally, when the dollar is this strong, gold should be getting hammered, and it's not.
Well, I think that's all the more reason that you should be buying gold. As you know, I wrote a piece about this. I love the gold. I think it's showing all sorts of signs.
Yeah.
I think the central banks, if you go look at how many central banks are buying gold over the last few years, it's through the roof. It's a reverse to trend of the previous decade. And I think that all those market relationships that everyone else is counting on, when they break and they don't do what you're expecting, it's the thing when you should be paying the most attention to it. I really, really believe that when a market doesn't do what it should do, that's a better signal than any other thing that you should go, and it's telling you that there's some real strength there. So
you heard it here first.
Yeah,
you heard it here first. Kevin Muir says buy gold.
I think it's a very
don't walk it back. Just own it.
Okay,
own it.
I like the gold. I'm like
right,
Austin Powers. I'm like gold member or whatever his name is.
Yeah. I love gold.
I love gold. Okay.
All right, let's move on. All right, so Kevin, parting words of wisdom. Who's sharing us the little tidbit?
Kind of the second best hedge fund manager in the world, because first
after
I think is Stanley Druckenmiller. I think is the number one.
And of course, the man who employed Stanley. That's
right, is George Soros. And George Soros has this line. He says, "I'm only rich because I know when I'm wrong." And I think that's after reading, I've read every book on George Soros that I could. And one of the things that I'm most impressed by him is his ability to change tack. He's not scared of being wrong and then flipping the other way. And this saying of his is very instructive, because it basically shows you that his willingness to admit he's wrong. So many people I see all the time, they get something in their head, they say something, and then it ends up being kind of who they are, and they end up fighting it even as they are wrong. And it's just
a perfect example. A perfect example is I'm not going to name any names, but there's a few people out there that are very prominent financial people, not necessarily crypto people, but they bought into the cryptocurrencies, and they've been defending it for the last year, saying that it's going to keep going, and they just can't admit that party is that's over.
Yeah. Well, they should be like us. We're wrong all the time, eh, Patrick? We're actually more surprised when we're right. No, but I really think that George Soros has got. One of my favorite George Soros stories was that whenever he had some problems with his account, with his portfolio, and he felt that he wasn't thinking straight, he would phone Goldman Sachs up on a Friday.
Fax them.
Yeah, but he would phone them up and say, "Listen, I want you to take me out of my positions this Friday afternoon," and he would fax them his entire portfolio on the Friday afternoon, do the trade, and then start over again. And the interesting thing about it is he would go and buy stocks that he had actually sold on Friday. And like, to me, that just shows you the discipline and the willingness to kind of say, I need my mind to be clear. I need to think about things without kind of, a preconceived notion. So I'm going to sell it all. And then if I still like it, even after I've gotten rid of it, I'll buy it again.
That's
and
genius,
I just think,
actually.
I think it is. I think the guy is one of the best traders that's ever lived, and you can say what you want about his politics, but as a hedge fund manager, he's unparalleled apart from Stan.
Well, you know what? It's true. Parting words of wisdom. All right, let's move on.
Well, Patrick, it's good to have you back, bud.
Thanks.
I hope things work out at home. I hope that. I hope she takes you back. And
oh no, it's all over. I got the key back to the door. She has to accept the fact that I'm back.
You're one of the hardest working guys around. Although I don't know how much work was actually done in San Francisco. But anyways, it's good to have you back. I've enjoyed working with you, and the fact that I don't have to edit this is just it's a huge plus for me. So let's do our stuff, our parting things here. So let me, I guess this is my spot where I'm supposed to jump in. Thanks for spending some time with us. Please visit our site at markethuddle.com to sign up to receive our weekly email that will include a link to the show and the charts that we will discuss, that we've discussed. Rest assured, we will never clog your email with junk, and we will only send you our weekly letter and updates for upcoming shows.
And you could also follow us on Twitter at The Market Huddle, or as well, you could follow Kevin at Kevin Muir or myself at Patrick Serezna. So thanks for listening to the podcast. Make sure you hit the subscribe button and follow us on YouTube, or make sure you follow it on the podcast player. And we look forward to you seeing you all online next week.
Yeah. So, Patrick, are you going to be here next week?
I will.
You will.
I will. I am going to make that only an infrequent event. Sometimes shit just happens.
I understand.
We
I'm
need
just
it.
giving you a
But
hard time.
it's so awesome. A shout out to Tony. Thanks for stepping in. Got some great comments. Everyone loves Tony, so it's we'll welcome Tony back to as the third musketeer to kind of hold the fort when one of us can't do the show.
And Patrick, I'm so proud of you. You managed to go the whole show without insulting our sponsor. Good for you, bud.
Well, you know what? It actually, the beer was good. No, you know what? It was. Listen, when what I don't like is when you drink a really hoppy beer and it punches you in the face like you didn't see it coming, But this one, it made it very clear it was coming. So I sort of, when I cracked it open, I knew what I was about to taste. And then as I was drinking it, it actually grew on me. I liked it. Everyone should go pick up some Hops and Robbers. It's a good beer.
There we go. We might have a sponsor that comes back more than one day, more than one show.
All right.
Thanks
anyway, so thanks everyone for joining us, and have yourselves a great rest of the weekend.
Take care.